Hi guys, and welcome to my channel. My name's Tim, and this is going to be an epic one. Today's episode, I'm going to predict what is going to happen with the stock market in the next decade. So not only am I going to look at the next potential major crash, but I think I've got some evidence to show what might happen over the next decade. And I know you're thinking, I've lost my mind, I'm going crazy, and I think I'm losing my mind a little bit myself. But everything I'm going to show you here is all backed up by data. There's no opinions here. It's all backed up by data, and there's some really strong signals to suggest this is the way the market is headed, based on what it's done in the past and where we're going now. So this will be an exciting one. Stick with me. I'm going to put in timestamps because this is going to be a long video. I can tell already. It's going to be what I call the Back to the Future episode. So I started looking at 1987 and the stock market crash that occurred then. And I decided to do that just for fun. I just wanted to see what was going on and whether we could have predicted what happened in 1987. But then that took me on a journey back to the 50s, 1950s. Then I went back to, I think I went back to the 30s and then back to the 80s. And then we'll go into the future. So this is going to be a big one, and I can't wait to get into it. So make yourself a coffee, a cup of tea, sit down. This is going to be an absolute nerd fest. It's all data related, it's all evidence, and I think I've got a really strong prediction about what will happen in the future. Of course, not financial advice. It's purely here for entertainment purposes. But this one will hopefully blow your mind as much as it has blown mine. So let's get into it. Now, this is the Dow Jones over 100 years. We've seen this before. You can see these big periods here where it went up 17 years and then went sideways 17 years and then went up 17 years. It's gone sideways 11 and then now it's gone up 11 as well. So that's just to set a bit of overall context. But what I want to do first is I want to go back to the future, and we'll go back to the past rather, and have a look at this period here in 1987 as our starting point, because this was a crash. Now let's have a look at this period in time. So you can see here we're in 1987. There was a stock market crash, and it was referred to as Black Monday. Now I did some investigation here to see what caused the Black Monday crash. And you can see it's a little bit vague. There was talk about some sort of computer, some computer that was involved, and stop losses were automatically being triggered. There was also talk about excess going on, which is always a sign of a market crash. They mention here that the price to earnings ratio, the PE ratio, was above 20. And just to give you an idea, the current S&P 500 PE rating is about 46 in the current day. So if they were worried about a 20, the current time is also a bit of a concern. So there wasn't really a clear-cut explanation. So I thought, I'm going to have a look at the data. I'm going to try to see if I could have predicted, or we could have predicted at the time, that this crash was going to occur. So what I'd like to look at here is, on the screen, I've got the blue line, which is the price. This is the monthly price action. Now, the blue shaded area is the 30-month moving average. So it's almost like a short to medium term average price. Then the red line is the 300-month or 25-year moving average. So we've got three different time periods. We've got 25 years, 2.5 years, and then we've got 1 month. Okay, so the first thing I'd like to do is just bring your attention to this area here, and you notice that the circle I've shaded in here, all three of those things have kind of converged into one. And if I go back in time just a little bit, you can see at this point, they're separated. You've got the monthly price action bouncing off the 30-month moving average, but we're nowhere near the 25-year average, are we? But at this point, everything equalizes and becomes one. And I've noticed through history, whenever we equalize and all these averages come together, it basically sets us off for an epic bull run. Look at that. We had a 17-year bull run. And if I go back in time to when we equalized previously, it was just after the 1929 crash and the Great Depression. We finally came up. You can see we're cutting through the MAs and so forth here, just cutting straight through them like butter. And then right about here is where we equalized. You can see we've got all three. We've got the long-term moving average, the 25-year. We've got the medium term, which is the 30-month or 2.5 year, and we've got the monthly price all together. And then look at this. We go on this epic bull run. Okay. So right here, in fact, going back a little bit here, this is 1966. It's that bull run that I just mentioned. We got to that point, and we happened to be about 14% above the moving average, which is not that high. That's pretty normal and pretty healthy. But we were 148% above the 25-year average. Okay, so the medium-term average were only slightly overextended, and the longer-term one was 148%, which is reasonably high. Nothing too crazy, but you can see compared to where we started, when they're all together, you could draw a big triangle basically over this phase here. You can see that we did get to a point when we're overextended beyond the 25 years. So then what we did is we actually went sideways for 17 years until we actually caught up. So we caught up to the 25-year moving average. So price stayed the same, or the market value stayed the same. We go up and down here. We actually had a little bit of a crash here, and I'll come back to that. But essentially, we went sideways for 17 years until all three averages have equalized again. And then that started our next epic bull run. And the 1987 crash comes in at the very start of this bull run. So you can see here, right at this point, this is 1982. And then 5 years later is when we had that crash. So if you put yourself in the mindset of an investor over that time, if you were involved in the market over this 17-year period and you experienced this massive crash here in 1973, 1974, you can see there's dips here, there's dips here. Essentially, we've gone sideways, nothing's happened. And then finally, we start having a period of time where all of a sudden we start making money. You can imagine the average investor on the street would have been like, we're starting to get rich. This is great. And even the media got involved. So the movie Wall Street from 1987, it came out in that year, 1987. So you can imagine the market sentiment around that time. People are starting to make money in the early 80s and the mid 80s in the stock market. So it was an exciting time. So let's zoom into what happened at that point. So I'll just zoom in a little bit here. So you can see again, you can see here what we did is we started off at this point. We actually bounce off we bounce off the 300-month or 25-year moving average at this point. Everything's equalized, and we start bouncing up on the 30-month moving average. Now at this point here, we were actually 38% overextended. Okay. Over the 30-month moving average. Now, I had a look over time back in history to see when was the last time prior to that we're overextended by that percentage. And it wasn't until way back here, November 5th, 1955. Okay, now I will be honest here, it wasn't exactly November, it pretty much is actually. So, but you can also measure it from here too. I think that's roughly the same time. But I picked this date because we all know that that's the date that time travel was invented by Dr. Emmett Brown. So anyway, in this period here, around 1955, this is when we'll last overextended by that much. So that was actually about 32 years, or roughly, about 32 years since. So the market had never been that overextended since. So it would have been a pretty scary time. We've had 17 years of going sideways. We had a massive crash here, and now we're starting to go up. But we are overextended. We got overextended here and we came back to the MA, but then we started going up here. This is almost a parabolic run. Now, I'll just cover up the screen here. And if you can imagine, put yourself in the shoes. And just look at the difference between the 30-month MA and the monthly price action. And you can see we're starting to creep up quite high. And you can also see we're starting to creep up higher than the 25-year moving average as well, okay? Now, at that point, what we should have done and what a healthy market would have done, and it started to do this, is actually go sideways until we catch up with the moving average, and that way we've brought the market back to where it really needs to be, so it doesn't get too overextended. But what we did instead, and it was probably because this was the first time in 20 years or so that people were making some real genuine money on the stock market, that we went sideways for a little bit, and then look at this, we start shooting up even higher until we get to this point here. So by this point, we're overextended on the 30-month moving average, and we're overextended on the 25-year moving average. And this is the most overextended we've been for a long, long time. And in terms of percentage-wise, we're talking 46% above this moving average, the 30-month, and 169% above the 25-year. Now, to compare that to the Great Depression, down here, the Great Depression were only slightly higher in terms of being overextended above the 30-month moving average, but were much more extended above the 25-year. And as you can see, that caused a major crash. So it didn't look quite as bad, but it was getting close. So if anyone says they didn't see this coming, then it's not the greatest excuse, because there's definitely a lot of evidence here to show that we're likely to have some sort of correction at this point. Now you can see here, I can draw this it's almost like a triangle shape. Have I done this correctly? Something like that. So there's a bit of a triangle shape here. So you can see that we've grown far above the 25-year moving average, and we've also gone up above the 30-month moving average. Okay, so I thought that was very interesting. Now, unlike 1929, when we crashed through like that, this time around, we actually only came down to the 30-month moving average. So to me, this was just a healthy correction. There's nothing in the data, like I'm sure the people involved, a 30% drop would have been devastating, especially after, they've finally got some luck with the stock market, and it's going up and people are making money and they're feeling good. And then this was just a reminder that you've got to be careful, and that the stock market, auto corrects. It brings people back to reality, and the moving average, to me, is the reality check. Okay, so I think they were lucky that it didn't crash through and go down to the 25-year moving average. And perhaps the reason it didn't do that was because we'd touched the 25-year moving average not too long ago, back in the early 80s. It was only 5 years before. So there was enough confidence, I believe, in the market to just go, you know what, we're off on this bull run. We don't need to come and test that again. Okay, now that's an important point, and I'm going to come back to that. And that's one of the first clues that tells us what may happen going forward in the next decade. Okay, so this is a real clue in the history that can help us predict what is going to happen. So this is mind-blowing. I'm really genuinely excited about what we're seeing here in the data. Okay, so I know this is a long one, but I'm just want to get through it all. Okay, so when they came back to the moving average, you can see over the next year or two, still in 1988 here, so pretty much for the next year, we stayed pretty close to the moving average. You can imagine the market was a little bit hesitant after this big run up, and it came crashing down to get off and running again. But as you can see, they went off on this epic run here. Now this is where it also gets interesting. So 1987, 1988. So we're starting here at 1998, and we are touching the moving average, which is quite healthy. So that's 1990. So that's a 2-year period there. We come back to it around 1994, but we didn't quite touch it. So again, we're starting to get a little bit overexcited here. You can tell whenever we don't come back to touch it, it's a worry. And whenever we don't touch the longer term moving average, it's a worry. But we don't have to touch that all the time. We can as you can see. In fact, I think did I measure that time period? I think I did measure it, and it was 37 years. So I'll zoom out to this point here. So this point here to this point here was about 37 years, I believe. Yep. So we had a 37-year period where the 25-year moving average basically moved like this. It touched the bottom of the 1973-1974 crash, which again is an interesting point, and then we equalized here. So about 37.5 years. And to give you another clue, we have not touched it ever since. And but I'll come back to that in a second. Alrighty. So where was I? So at this point here, we're in the 90s. Now we're leading up to the dot-com bubble, and it's interesting because when I was doing this analysis, I thought the dot-com bubble was a bit like the 2008 financial crisis. It was one particular sector that brought down brought down the other markets. But what I'm seeing here is that the Dow Jones, which has got a lot more companies, or a lot different companies than just the tech companies that were involved in the dot-com bubble, it was doing the same thing. You can see, instead of touching at this point, instead it starts to accelerate, and you can see that there's a clear acceleration here in the moving average. So we're starting to go a bit more parabolic. So there were clues way back here in the 90s that, okay, we haven't touched the moving average. We haven't gotten near this moving average for a fair while now. Like it wasn't since 1982. So there's been a fair while since we've touched that moving average, and now we're starting to accelerate. And we got up to this point, and I just made a little observation here too. This looks very similar to the COVID crash. We had after the end of a long bull market, we've had a little crash down, and then we've almost ignored it and kept going. So I'll come back to that point too, maybe on if I remember. So right here this is the time of the dot-com bubble, and what I'm suggesting here is that even though the dot-com bubble, the tech stocks get all the bad rap, I think the market in general was due for a crash. And you can see here that we are 23% above the moving average, which is not super high. It's relatively healthy, but we have had 17 years of going up. So we've had a 17-year bull market. We're a little bit overextended, but not much. But then, compared to the 25-year moving average, we are 289% above. Now, if we go back to, I haven't got it on there. If we go back to 1929, we were 285%. So we're a similar height above the 25-year moving average. In fact, we're a little bit higher than we were in 1929 when we had this massive crash all the way through. Now, our 30-month moving average is much lower than it was in 1929, and there's a different time period and so forth. But that's just something that is interesting. So we were kind of due for some sort of crash. Now, what you'll notice here is that after the dot-com, we're into the 2000s now. And again, what we did is we essentially went sideways for about 11 years. Okay, and you can see right here, it's very interesting, but we come close during the financial crisis. We come close to touching the 25-year moving average, but we didn't quite touch it. Now, what I noticed about this sideways period, so we went sideways for 11 years, and we came close to touching the moving average, but we didn't quite. I went back in time, and I thought, I've seen that before. So I went down to here to 1974, and you can see 1974 is when, just after we turned the point of going sideways. So 1966, we decided to go sideways for 17 years, and you can see that we touched the 25-year moving average right here. And you can see it was almost a precursor. It was almost like, we were going to touch it. And it was almost like this could be almost predicted. It's fascinating when you look at these charts. Like, That is like a straight line. It's pretty unbelievable. So we touched it, okay, and then we equalized, and then that allowed us to set off for the next bull run. But where we are currently up here, you notice we haven't equalized. We've touched it. So what I'm wondering is whether this is a hint, that similar to that period in the 60s and 70s where we went sideways and then we ended up getting closer to it. And you could almost argue, maybe that's a line there. That's a line. I don't want to make too many more conspiracy theories here, but so we've touched it, but we haven't equalized, and now we're creeping up again. So we've gone up 11 years, okay, and now we are at a point. We are now at a point here where we're overextended again. If you look compared to the 25-year moving average, we are currently 139% above that, and we're about 22% above the 30-month moving average. So those figures there are not too scary. 139% and 22%. So if you compare that to here, this was just before the financial crisis. We're a similar percentage above the 25-year, and we're slightly higher than the 30-month. So we have crashed before from these heights. And compared to the .com era, we're a similar percentage in terms of above the 30-month, and we're nowhere near as high in terms of the 25-year moving average. Okay, all right. So picking up the action, this here was the .com bubble era around the start of the year 2000, and now we find ourselves, we went across 11 years, and then we went up 11 years. Now it's interesting because if I zoom out to this map again, notice how we went up 17, went sideways 17, and that's when we equalized, and then we went up 17, and we went sideways 11, and we haven't equalized yet. So I thought, what would happen if we had gone across 17 years here instead of 11 to keep this same sort of healthy market action going? And this is where it gets really interesting, because from the year 2000, if we had have gone sideways for 11 years from this point, we would have actually met, look how interesting this is, we would have actually met the 25-year moving average, would have actually touched it right here in the year 2017, 2018, okay? And that would have been healthy, and that might have set us off for another epic bull run of 17 years. But instead, what we did, what we did is we started going up again, like this, okay? Now, this is a little bit scary, because if we had have touched the 25-year MA there, that would have been a 37-year period, okay? Exactly the same as what it was over this period here. But instead, we are overdue, essentially. We are overdue to touch the 25-year moving average. It's happened a couple times in the last century, and whenever we do and we equalize, it basically sets us off for another bull run. But it kind of acts as the end of one era and opens up the next. And it just seems like we've kicked the can down the road. So I'd be very interested to know if anyone could comment down below what happened during this period of time here. What did the governments do? Is this an example of kicking the can down the road and basically interfering with the natural market cycle? Or did the market just decide to do this on its own? So I'd be very curious if anyone's got any thoughts. But I decided to try to extrapolate. Because the 25-year moving average moves very slowly, we can kind of, with some level of accuracy, work out where it's going over, say, the next 10 years. You probably can't predict any further than that, but we can predict roughly where the 25-year moving average will be, okay? And what I did is, I looked at, since we went up 11 years, or we went sideways 11 years, and we've gone up 11 years, what would happen if we go sideways from where we are now, okay, just like this, and come to this point where we equalize? And I measured it, and it's exactly 11 years. So it kind of all lines up very, very well that we're overdue to touch the 25-year moving average. We've gone sideways 11. We've gone up 11. Now, if we go sideways for another 11 years, we should touch the 25-year moving average, and that should kick us off for another potentially 17-year bull run. You know, if history starts rhyming and repeating what it's done in the past. If we don't go sideways, if we don't do this, if we keep going up, then what I'm expecting to happen is that we will still end up at this same point. We'll still end up there, but it will be just a lot more volatile. If we go up like this, actually that might be a bit too high, but if we go up about this high, let's delete that. If we go up another few percentage, and that will be similar to the other crashes that we've had in the past, whenever we go up around this kind of percentage above where we are now, it's always resulted in a crash. Now, we often crash back and we bounce off the moving average, but we are so overdue to touch this 25-year moving average. It would not surprise me that we actually touch it or even fall through it, and if so, we'll probably come back. But as we can see, there have been precursors. There's a precursor here, there's a precursor here, and now this could be, even COVID didn't even register there. That's just a tiny little correction. So I don't even, almost count that. We've seen these precursors before. So you can see the precursors there leading to, and this one actually did touch back in 1973, 1974. So we're overdue. We're basically overdue to equalize and touch this moving average, okay? And there's multiple ways we get there, and we either get there the easy way or the hard way. In fact, there's no real easy way. It's either we go sideways and get there without much volatility, or we go up and then crash into it. Maybe we crash like that, and then another crash or something like that, and then we equalize, and then off we go again. So with some level of it's still speculation, I must admit. This is still speculation. But using past history and looking at these moving averages and looking at the pattern, I would say there is still a reasonable probability that the market does something along these lines over the next decade. And now lastly, what does this mean for Bitcoin? I just want to throw a little extra one in for Bitcoin. So Bitcoin has existed during this period here, a complete bull run of the stock market. And this has been the perfect time for a speculative asset and class of assets, crypto, to thrive, okay? So I think that's, and everyone's expecting crypto, or not everyone, but a lot of people are expecting crypto to just keep this epic momentum going forever. But what happens if we have a similar situation to what happened here in the year 2000, when things are going great, all these speculative emergent technology assets are going up and doing great, and then they crash, and then they took a decade or so to recover. Some haven't recovered at all. If you look at Yahoo, it still hasn't recovered. Amazon, it took 8 years till it reached its previous all-time highs. So that is a question mark for crypto over the next decade. It will be interesting, and only time will tell. But anyway, so I told you this would be an epic video. It's extremely exciting. It's extremely scary. But again, history hasn't been, or the future hasn't been written yet, as they would say in the movie Back to the Future. So anything can happen. But keep an eye on this space. Hope you enjoyed the video. Please subscribe, like, share, and comment below if you think I've lost my mind. I'm happy to take that also. And I'll see you in the next one. So cheers.